That's not a problem for you, Ben. You don't eat broccoli, do you?
Oh, I love my broccoli. I absolutely love my broccoli. I love my greens. This is a really important question because what we need to understand conceptually is a couple of important points. The first one is that inflation means our money will buy less. So inflation can be a dangerous economic instrument if it gets out of control because our money buys us less things. Now, you might be arguing, well, that's easy. All I need to do is we just need to then lift our wages, right? Well, the answer to that is no, because it's not just automatic that businesses can just lift their wages of their staff. And in a lot of cases, a lot of businesses run on very tight margins. And if those businesses start to collapse and break down, then ultimately unemployment starts to rise and it starts to be a vicious cycle. What's been happening in economic cycles through many, many decades and so forth. Most reserve banks and sort of central banks around the world think that if you can run inflation between 2 and 3%, you can optimize for future economic growth. And so the idea there is you can have stronger periods, stronger cycles or longer cycles of economic prosperity where you're growing gross domestic production, as opposed to when you have, say, inflation running at 6 to 9 or 10%. And we've seen what happens when it does get into that sort of realm and there is an expectation that's being set. We only need to look back to the 1990s in this country where we talked about the recession that we had to have. That was a manufactured correction in the market to slow the economy down and to get wages and inflation under control because it was unsustainable. You are right in saying that this had been imported. So in the first instance, it was definitely imported inflation. On the back of Russia invading Ukraine, we saw energy costs, namely oil and gas, explode in value on the global markets. And also Ukraine is one of the biggest producers, if not the biggest producer of wheat in the world. And so ultimately food security and food prices also spiked in global markets. Yes, it's very true that the supply side, and we imported a lot of that inflation pressure in the first phase of that. But here's what happens from a mindset point of view. And this is the risk that we've got happening right now. And that is domestically, we are definitely seeing domestic inflation start to show its head. We're actually starting to see demand-led inflation. Now, the risk of demand-led inflation is that businesses then start to say, well, I think I can put my prices up. I think everyone will happily pay me a little bit more because, hey, if everyone else is doing it, I need to put my prices up. Now, the problem with that is if wage inflation doesn't continue to grow, if real wages don't grow, then effectively our net outcome for the people in the economy is that our money buys us less. And so our standard of living is also compromised as part of that. So that is all the moving parts going on. And so why the RBA is saying we need to get in front of this inflation story and start to bring it under control is because of that risk that it comes into the psychology of us and our behaviors. And we just start to expect to have a higher inflation. And then we start to expect to have higher wages. And then we get into, these more higher boom bust cycles, also forces into, more severe recessions than we really want to have. So it is very much a manufactured, and it's very much an instrument in which the RBA is in control of to try and reduce the amount of demand in the economy. But that is the challenge that we've got here. And what happens in a lot of cases, just to finish off here, is that if you don't get in front of it, it can continually build a life of its own. And so you sometimes need to be quite aggressive in terms of putting the inflation genie back in the bottle. And that's what we're going to see the RBA doing at the moment.
There's also the need to create a buffer in place for any future shock event that might come up. No one predicted GFC beforehand. It was new, right? It wasn't something that we didn't experience before. No one experienced COVID before. Whatever's going to happen in the future is likely to be something that's mind-blowing to us now that we would not have anticipated. So by actually having also an instrument in place where interest rates are being ratcheted back up means that there is also a mechanism in place, because when GFC happened, we dropped rates. When the COVID happened, we dropped rates. But if something happened and you're at 0.1%, that's an instrument that you can't use. Why that's so important is so that boom bust is no good for anyone. I was a teenager during the recession that we had to have, Ben, and it wasn't pleasant because we were in a middle class, lower end of middle class family, and that was affecting us. And it affected the psyche across the country as well. And that was probably more painful than anything. So I guess part of it, Jess, is that people will need to realize that with interest rates moving as they are, we are going to make those adjustments. We made adjustments on the positive when interest rates went down and we started having more surplus and more money and more repayments and more things to spend. It's just an awkward human nature things when we have to adjust it back on the upside, because no one likes to have less. But what we do know is that the majority of people in this country will do whatever it takes to keep the roof over their head. This is not America where you have non-recourse lending. You have recourse lending in this country. You can't just put the keys back in the mail, send it back to the bank, move out and move on with your life. There is a psyche and a culture about having the roof over your head. There is recourse lending in our system. We want to make sure that there's no systemic risk that comes from this. So as painful as it is that we are experiencing what we're experiencing now, I think for the better part, we will look back at it at some point in the future and go, thankfully, we did do that, Ben.
It's a balancing act, Bryce. It's really, to Jess's point about, it's really affecting us because things are getting harder and standard. The intention is to reduce productivity in terms of non-discretionary spending. They are trying to taper that down because they want businesses to doubt whether consumers will pay more, right? They absolutely need to do that. Now, if you also put the double whammy in there, which was the floods, you also saw a lot of crops getting wiped out. So the essential spending, the non-discretionary stuff, which is the staples, the food, those types of things, also were impacted. And that was a domestic impact. That was very much supply side, but domestic supply. So hence why lettuces hence why we're paying, as you say, for broccoli now.